I'm Jason Yarusi of Yarusi Holdings. Welcome to this week's weekly webinar. Today we're going to talk about tips for financing multifamily properties. But before we do that, make sure you go down there to hit that follow button. So each and every week as we bring you a new topic, something really dialed in for multifamily investing, that you too can be alerted of that. So I'm Jason Yarusi of Yarusi Holdings. We're a multifamily investment firm here in Middle Tennessee. We've now been focused on multifamily acquisition since 2016, acquiring over 2,000 units across 5 states here in the Southeast and also some in the East and Midwest as well. So today we're going to talk about tips for acquiring or tips for financing multifamily assets. And there's a lot to be said here, right? So when you look at the multifamily asset that you're looking to acquire here, you have to think about what's going to be the right tool, right? So we want to think about that side of it instead of just thinking, hey, let me find a lender and any multifamily property I will have, I'll just go to this lender to get a loan. Well, there's all kinds of different lenders out there. Credit unions, community banks, regional banks, large banks, Fannie and Freddie, life insurance company, right? There's endless bridge companies, right? All the CMBS, there's all these different loan products, right? And each is going to have a different context of where they can be used. So as you think about your property today, you have to say, what am I trying to do with this property? Right? Is this a property that is already stabilized, right? That we're just going to collect coupons? That might be one type of loan. If it's a property that's an older property, a lot of deferred maintenance, can have a ton of construction or capital expenditures that will need to be done, right? That's going to be another type of loan. So as you look at this, you have to understand, what am I trying to do? What is my game plan? Because you need to have a business plan when you talk to the different banks out there. Because the question is going to be, is you are going to be interviewing them just as much as they are interviewing you. The reason for this is you want to make sure that they're going to be the right fit, right? You don't want the wrong loan product on your project because it's going to hinder you as you go forward. So an example would be that one is a bank that's not very affluent for renovations, right? If you're going to do a large renovation play, hopefully you're thinking that you're going to increase the value of the property and potential bring some of these value out into the future, right? So having a loan that has a prohibitive prepayment penalty or something that's going to impact you or not allow you to move to a different loan in the near term is going to, one, limit your ability to really succeed in your business plan. That would also come in fact if you're thinking about, of course, selling in the next 1 to 3 years, and you're getting a loan on that's a 10-year term, which again has a very prohibitive prepayment penalty, you may find yourself on the wrong side of having to make a decision to keep the property longer than expected because of the future payment that you would need to make to be able to get out of that loan. Now, interest rate, variable versus fixed, right? It's going to come down to the risk profile of your property, what's going to work very good for your property, and just what you see as the future outcome. Loan term, right? It's going to come down to match your business plan. If you're going to take on a 1 or 2 year loan, well, you have to understand that you're going to be at risk of market exposure, right? So where do you need to be able to put yourself in a better position with that loan in the short term, in the next 12 or 24 months? Also, term loan, right? Again, so if you're going to put a 10-year loan on it and you don't know if you're going to keep this for a long time, you have to say, what's the benefit of putting on that type of loan onto this product? If you go local banks, they may be easier to work with or have a more expandable box. However, they may not have the best rates. But where you do sacrifice on maybe rates or terms, or even amount of amortization, you get back with flexibility. Maybe they have no prepayment penalty. So in the end term, it could be a great fit. Also gives you the ability to jump or move into a different loan as you create value in the property. But on that same side, they may have some built-in recourse that is on that loan. So understanding all different formats for a loan is going to give you the best enhanced opinion of where you should put this project, that it can benefit you and your investors in the short term and the long term as you go through your business plan. All right, so I'm Jason Yarusi of Yarusi Holdings. That was some tips. Here are some thoughts about investing in multifamily, how to find the prime multifamily financing that's going to fit your project. Talk to you shortly.